Sensex gaining in the excess of 300 points, Nifty firmly above 11,300. Broader markets, fantastic uptick seen there. Mid and small cap, both the indices gaining in the excess of 1.3, 1.4 odd percent. You have all the sectors firmly in the green this morning. There's Nifty Metal, which is down about 0.5%. But look at a pharma space, 5.2% higher for Nifty Pharma. You have Nifty Auto gaining 1.5%, Nifty Realty gaining 1.7%. Even PSU banks are gaining more than 1% in trade. Nifty Bank looking very, very firm, has gained a little over 200 points as we speak. Financial services looking fairly good. It's also up a solid 1% in trade. Yes, so barring the pharma space, like I said, everything is looking very resilient. Cipla is up 8%, M&M is up nearly 6%, L&T is up 4.5%, Tata Motors 4% higher in trade, DRL and Sun Pharma, both heavyweights from the pharma space, gaining in the excess of 4% each. So clearly it's a day that belongs to the pharma space. But for now, let's move right on and talk about another stock in trade, that's ENIL. The stock is up a good 1% in trade. They delivered their numbers as well. We have the management joining us to talk about the quarter gone by and the way forward. Prashant Pandey, the MD and CEO, and N. Subramaniam, who is the group CFO. Both of them are with us this morning. Good morning, gentlemen. Thank you for taking time out. It's the worst quarter in a decade for ENIL. Talk to us about is the major part of the pain behind us, or do you foresee some more challenges in the coming quarters too?
Well, I think clearly the biggest pain points are behind us because the lockdown, which no one can plan for, are now well and done with, right? And every government, be it the central government or the state governments, have now been repeating ad nauseum that no more of those blanket lockdowns. If at all there are any lockdowns, they'll be limited to certain areas and certain time zones and those kind of things. So I think the worst is truly behind us, undoubtedly.
So what would you say has helped the margins, Mr. Subramanian? If you could give us some commentary on how the trajectory could shape up in the future as well?
Yeah. So a couple of points. One is that the top line has declined because of the pandemic and the lockdown. But if you look at our solutions business, that has held up very well, right? That's grown faster than our FCT business. And the important factor is that in our solutions business, the on-ground elements, while the on-ground elements have come down quite significantly, the digital component has expanded pretty rapidly. And that is one of the reasons why you see a big jump in our solutions business. And we also had significant income from brand licensing. On the cost side, we have seen a significant reduction in cost, right? We've seen close to 20 odd crore reduction in a quarter in our fixed other operating costs. This is the non-DVC, non-license fee, non-royalty piece, right? Excluding depreciation. And, when the top line growth resumes, certainly in the second half, we expect significant growth in top line when clients start spending large sums on marketing. On the back of that, we expect significant gross profit and EBITDA growth.
Okay, all right, that's heartening to know. What has been the ad revenues, Mr. Pandey? What is the outlook? Are you witnessing any pickup in advertising side?
So look at the sectors which have started to come back in the months of July and August. So auto sector is back in a very significant way. A lot of new brand launches happening, a lot of companies coming back with new products or with liquidation of their existing inventory and other such things. So auto sector is doing reasonably well. The FMCG business has come back. BFI segment, which was doing quite well even in the first quarter, actually the radio business grew compared to last year in the BFI segment. That's continuing to hold up. So there are segments which are doing well. The segments which are still not doing well, obviously, are the retail, the pure retail segment, or let's say education, which for radio companies is largely retail education rather than internet-based education. So that's kind of still in the slump. But overall, a lot of sectors are starting to look up. But remember that the base effect is still there. So while the first quarter, there's growth over the first quarter, don't forget that the first quarter base was so badly hit that there really is a very, very long room to still go to catch up with last year. but things are looking up.
How are you focusing on the digital front now? We've been hearing a lot about Radio Mirchi going big on digital platforms as well. So how is it that you plan to scale that up? Are you putting any interesting strategies in place that the investors should also be aware of?
So digital is a business that we've been growing for many years now. And there are 2 or 3 different parts of the digital business, all of which are doing very well. Let me talk about the first part. The first part is when we provide solutions to our clients, and the solutions go way beyond radio, and they include a lot of digital solutions. So we today make videos for our clients. We package in our influencers, our RJs who are very big celebrities at a local level. We put in their social media handles. We do a lot of stuff basically which involves creating activation on ground and then using social media to amplify. So that's one part of digital which is doing very well. The other part of digital that we have built over the years is the whole video business and our whole YouTube presence. For instance, we today have 3 YouTube channels which have more than 1 million subscribers. And in fact, the biggest YouTube channel that we have, which is Filmi Mirchi, is actually the biggest Bollywood channel that exists, the Bollywood entertainment channel that exists in India. So film producers and music companies are interested in leveraging this strength of ours. And the third thing about the digital business, which is very strong, is the ability that we have created of creating audio solutions for our clients. So there are clients who are not able to read media dark markets. We create audio solutions for them, put it out on the digital networks, mobile networks, etc., and deliver solutions. All these 3 components are doing very well.
Should we sort of believe that now you'll be looking at reducing dependency on FM business and focus on activations, concerts, TV impact properties, online radio, videos, etc.? Will this now come to a standstill completely, or will the pie reduce? How should we understand the mix to shape up over the next few quarters?
Well, we've been saying this for many years now, and the fact that the radio business continues to grow is a given. It will grow slower in the future, but it will continue to grow. And, because we are so strong over there and we have listenership leads and all of that, we are able to now take some of the cash flows which come out of the radio business and invest it into newer businesses where we are seeing rapid growth happening. So all these things that you outlined, whether it is the video business, whether it is the IP creation business, whether it is international expansion, whether it is concerts, all of these businesses are actually growth areas for us, and digital out of all of them. And, we make a lot of original content, which we also consider to be digital revenues. They are all growing very rapidly. So while the COVID pandemic has hit our on-ground activations and will continue to hit it for FY21 for sure, I think the pandemic will also give a big boost to our digital efforts. And I see in the next 3 to 5 years, Radio Mirchi being more Mirchi, which is 50% radio and 50% non-radio. In fact, to this extent, we have even unveiled a new corporate logo which basically says that we are Mirchi and radio is just one of our businesses.
Okay. Mrs. Subramaniam, if you could also talk to us about any cost rationalization strategies you may have undertaken, and what will be your capex, your costs. How do you plan to sort of control all of that, given the unprecedented circumstances that the COVID disruptions have thrown open? How do you plan to do, sort of mitigate the risk over the next few quarters?
As I said earlier in the call, if you look at our cost elements, there are 4 parts to it. One is the DVC, which will sort of decline if the activity levels decline, right? But the DVC has also declined because of another factor, which is because we have added more digital elements and reduced the on-ground elements. The second part is the fixed license fee that we pay to the government. That, of course, will continue at those levels unless the government grants some concessions. The third aspect, of course, is the royalty piece. The royalty piece, there is a variable component and a fixed component. The fixed component remains at that level, and the variable component will respond to revenue levels. The biggest improvement that we have seen is in our other operating expenses, and that's of the order of 20 crores for this quarter, right? So at the same run rate, it is around 80 odd crores for the full year. So that should provide a huge margin uplift when the revenue significantly improve, and we see a growth in, and on the back of that, we should see a significant growth in EBITDA. Coming to capex cost, we've completed all the big investments that we had to do, and on an ongoing basis, our capex is of the order of some 10 to 12 crores, right? It is not higher than 10 to 12 crores, and this year we expect it to be lower, more in the region of 5 to 6 crores. Yeah.
May I just add a small point here?
Okay, gentlemen. Sure.
Yeah. So, one of the things that is often not recognized is that media is facing a hell of a lot of distress. And media is in the same space as aviation or hospitality. But there's something that is not often recognized in the government. And, just to give you one number that, the way we have cut a lot of our operating costs is really by rationalizing our HR costs, which are down 25% compared to last year. 200 people have lost their jobs. There are at least 1/3 of the organization which is suffering pay cuts. I think somewhere the government needs to take note of this and needs to provide relief, because otherwise, broadcasters are in a really bad shape at this point in time.
Absolutely. Totally agree with you. Fair point. Thank you so much, Mr. Pandey and Mr. Subramaniam, for taking time out and chatting with us about how the quarter transpired. How do you plan to go ahead in the next couple of quarters, and what should your stakeholders and investors expect? The stock, meanwhile, is hovering around 129 rupees a piece in trade, up by nearly 1%. Moving on then, Kunal Bothra and Vijay Chopra both are with us this morning. Hi, gentlemen. Thank you so much for patiently waiting by. Kunal, coming first to you, Nifty above 11,300. What next to expect? Is the steady up move going to continue, or will we see some retreatment from this level?
So I think the up move should continue. I think today the AGR issue is, I think that could probably be an overhang for the markets, or it could probably cause some bit of volatility. But I think other than that, I think the markets are still into a fine fettle. Globally as well, things have remained, more or less a bit buoyant, except for Friday's session, where there was some bit of, slight negative price action for the US markets. But nevertheless, other than that, I think it's still, markets which are extremely buoyant. On the, on our markets front, on the domestic front, on the option front, the put call ratio on the Nifty is at 1.55, 1.6. So probably there could be room for another 50 to 100 points left on the Nifty on the upside in the very immediate term.
Okay, all right. Vijay, hi, morning. What are your wealth creation bets?
I think that, good morning. There are lots of ideas which are coming across. I think that pharma happens to be a good bet. So Sun Pharma seemingly is very good. It should cross 600 in the coming days. Stocks like Cipla are doing extremely well. I suppose that Cipla can go up to 850. Stocks like BBTC, this is the holding company of Britannia, which is trading at 1430 odd. I think that it can go up to 1600. And again, I'm fairly bullish on the IT pack, as I've mentioned several times, that the pandemic has taught one thing to the world, that they cannot do anything without IT. So the business should keep on growing consistently. So the likes of TCS, Wipro, Infosys are great bets at this point of time. Now, another thing which has come up is the ban on the defense items. So I think that companies like BHEL, BEL, BEML, these companies should hugely benefit from this initiative, and there's a lot of work which these companies would get. So these are few of the ideas. Apart from the metal back, I think that the metals should also do well. Today I'm seeing that stocks like Midhani, they are doing very well. A couple of other stocks I like in the spaces, NLC, the Neyveli Lignite, which is also doing well today. So these are a few ideas which I suppose should do well. And I've iterated in the last couple of interviews that Tata Motors seemingly is near a breakout, so we can see a major up move coming in Tata Motors as well.
Okay, all right. Cool then. Kunal, what are your picks from a trading standpoint? Which stocks would you like to talk about?
Buy calls. The first would be a buy on ITC. I think that this large cap name is just about nearing a decent breakout on the short term as well as on the medium term charts. So would suggest a buy with a target of 208. Stop loss could be kept at 194. Reliance Industries, I think the stock is still back in terms of news flow as well. The chart patterns are still very strong. It's not going through a big volatile phase, which is generally expected of a stock price of such category. But I think in this regards, Reliance Industries still looks very strong on the short-term chart. So I would expect another 50 to 60 points on the upside, at least in the very, very immediate term. So I would suggest a buy in Reliance Industries. Targets could be kept at 2,210. Stop loss at 2150.
Okay, let's address some viewer queries then. We've got a few Twitter queries this morning. First up is from Gaurav Anand. He's based in Delhi. He has 500 shares of Concor at 440 rupees a piece and he wants to know what he should do at this juncture. Should he add more or should he book his losses or should he wait patiently? Kunal, you were bullish on Concor for quite some time. In fact, the stock has seen a decent steady up move as well, barring today when the stock is come down crashing 15%. What should one do at this juncture?
The stock has broken major supports today. It's down. I think it opened gap down 7-8% approximately, and then it's just about fallen sharply beyond that as well. The volumes are also on the much higher side. So I'm sensing that there's some sort of news flow which could be attached to this stock, and which is why the stock is seeing a sharp kind of a correction. And it generally doesn't augur very well when you see such kind of a big volume price correction into the stock, into such kind of a stocks, because they go into steady uptrend and on one day these stocks tend to correct and fall by and try and cover the the rally of 2 months or 3 months. So in that regards, these are not positive signs for the stock price. I think 380 could probably be kept as a stop loss for the trade. If the stock breaks that kind of a level, say on intraday basis or on closing basis, then I believe we should look to exit the trade.
Okay, Vijay, what is your sense on Concor, and given the whole developments associated with the divestment as well, which is on the anvil, how do you think one should play this one?
Well, I think that surely stop losses should be maintained for any, even short-term or long-term investors. So I would give a bit deeper stop loss of 360 odd. One should wait there. But yes, most of the PSU stocks are reacting. Some on the better side, some on the worse side. I would say that one should hold on to this stock for some time and look at the developments which happen. We have gone through the worst pandemic, the stock markets know about. So I would say that the industrial activity as it comes back, we'll see a lot of activity happening in Concor. But yes, if at all there's a good buyer which comes and takes up a stake in Concor, I think that stock can come back very sharply as it has fallen today. But yes, I would say that just hold on with a deeper stop loss of 360. I don't think that the company has gone bad or anything, but yes, the situation, the industrial activity, the overall sentiment is not that good. But as sentiment improves, I think that there is a good chance that Concor can come back if at all there's a good investor which comes and starts investing in this company. So hold would be the call.
All right, moving on then to our next Twitter query. This is from Harish Nair of Chennai. Bought 100 shares in Amara Raja for 867. Wants to ask if he should continue to hold or sell at a loss. And perhaps if you have any other suggestions to invest that money elsewhere. Kunal, coming to you first on Amara Raja. Bought at 867. What's your verdict?
You can hold on to your investments. I think out of the two names, particularly Amara Raja and Exide, Amara Raja stands to be one of the strongest stock. It's withstood a lot of volatility, even though the stock is a bit low beta, so it tends to go into very small periods of uptrend and then more periods of consolidation. So I think that could probably be one of the reasons why the investor is getting a bit jittery, because on the other hand, there are a lot of stocks which are moving up higher, 5-10% almost on a daily basis. So you're holding on to a good quality stock. And I believe from a, if your horizon is long-term view, then I don't see any reason why you should be looking to exit the stock. But in case if you're looking to buy, other stocks as well, just to add to, your portfolio in that regard, then I believe you can look to, maybe look at, stocks like Tata Motors, which is just about on the verge of a breakout. You can look at even buying on, the pharma names. I think a couple of pharma stocks, they still look fairly attractive. Aurobindo Pharma, I still believe, is going through a strong cyclical, breakout on the upside. And the move is just about started on the monthly patterns as well. Dr. Reddy, Lupin, and you can add to many of these other pharma stocks on the large cap front, which you can look to buy even at current levels. So I think it depends on the kind of time frame. If it's from a long-term view, you should hold on to Aurobindo Pharma. And if it's from the other stock perspective, I just named a few of them where you can look at it from a longer-term view.
Okay. Vijay, do you concur with Kunal's view? Is Amara Raja a hold for you as well?
Well, I think that from the lows of almost 350 in the month of March, the stock has literally doubled up and more than that. So this talks volumes about the strength of the company, the stock, and I would say that look at what has happened to Maruti. The volumes have started jumping back. Look at Motherson Sumi. The entire auto and auto ancillary pack seems to showing green shoots of revival. It would take some time for sure, I guess. But specifically if we talk about India, we are going to head into the festive season, which is the most the best season for all the auto companies, auto majors. So I think that the auto ancillary companies should also do well. Also look at what Bajaj Auto, what has happened in Bajaj Auto and Hero Moto. So I am fairly bullish on the auto and the auto ancillary pack. It would take some time, but no need to panic and just don't exit the stocks. I think that these stocks are going to revisit the highs, and we are soon going to see Amara Raja crossing 800 odd levels. So definitely a hold from my side. The stock has shown immense strength and immense character. There are stocks which haven't come back at all from what happened in March. So I would say just hold on to the stock, and there are higher levels to be seen.
All right, so it's a consensus thumbs up for Amara Raja. Thank you so much, both of you gentlemen, for taking time out and helping our viewers out as always. Slipping into a break here. More stock-related updates lined up for you on the other side. Stay tuned. Welcome back. You're still watching Buy Now, Sell Now, and what a rally is being witnessed by all the defense-based sectors, defense-based stocks. You have a BEL on a tear, HAL, Bharat Forge, BEML, you name it, and they are all logging in the excess of 4 to 5% each. In fact, BEL up a solid 10 to 12 odd percent. Avan is joining us to tell us what exactly is the trigger. Avan, it's a big defense boost announced by the government, 101 defense items to go under import embargo. What does it essentially mean? Which are these items that they're talking about?
Well, there's a big positive step, as you said, within the defense sector. India will be suspending the import of the 101 defense items, and this is going to help boost the indigenous production and essentially just help as a major push for the Atmanirbhar Bharat campaign that the government has been, promoting. Now, these embargoed items include high technology weapon systems. So, for instance, artillery guns, assault rifles, corvettes, sonar systems, transport aircrafts, etc. And this will be progressively implemented over 2020 to 2024. Now, they've also split the capital procurement budget for 2021 between domestic and foreign procurement routes. A separate budget head has been created with 52,000 crore rupees outlay for the domestic capital procurement. And the defense items, the defense services have contracted items worth close to 3.5 lakh crores from 2015 to 2020, which are now on the hold list. Now, this is a big positive because this is going to, of course, help push the Make in India case. But not just that, it's going to give an inclusive approach to the defense sector and a lot more clarity that was much required. There's going to be long-term visibility when it comes to orders for a lot of these players. It's going to help to improve the domestic supply chain and the vendor base so that there is better execution of orders. It's going to be, given the fact that now there's more clarity, there'll be clear and time-bound specific item-wise imports, which will help all of these manufacturers. It's going to help them prepare better, commit more investments into the value chain. It will help to strengthen and augment the systems delivery capabilities. It will also, the fact that they're scaling up the defense turnover, this is in turn going to help reduce the import bill for the government, because remember, India is currently the second largest importer of defense equipment in the world. This procurement, capital procurement as well, will help to give a major fillip to the domestic defense players, because now the pie for the domestic defense players is going to increase over a period of time. And given the fact that there have been considerable announcements already, the sector analysts are all still expecting further announcements in the days to come and a little more clarity as well. So it's going to be a major positive for the likes of L&T Defense, Mahindra Defense, Bharat Forge, Bharat Dynamics, Cochin Shipyard, Hindustan Aeronautics, BEL, BEML as well. While these are major positives, there are still some challenges that remain. That if you need higher private capex, private sector commitment, decision making and execution, they're going to be the key to success, because you have seen many players that have clocked in suboptimal returns due to lack of clarity, slow pace of activity, or the fact that decision making has not been swift enough. But nonetheless, a big positive coming in for the defense sector.
Okay, Avan, thank you so much for that. Well, it's important to remember that this is not the first time that we have strived to ensure that there is procurement of indigenous products when it comes to the defense segment. And yes, nevertheless, we are still seeing a massive rally in some of the stocks mentioned by Avan. Look at a BEL, 12% higher, back above a 100 rupee mark is where BEL is trading. Okay, well, moving on, we will be having the latest AMFI data, and it's expected that equity funds may see an outflow in the month of July, and this in fact would be the first monthly outflow in 4 years. Last month, remember, there was a very, very small inflow number that had come in. Let's see what we're expecting this time around. In fact, a probable outflow, like I mentioned. My colleague Jayesh Khilnani is standing by with the expectations. Jayesh?
Movina, this is not the expectation, but the actual data has already been released by the Association of Mutual Funds in India, which is AMFI, and it is an absolutely disappointing number that we have got this time around. Though there has been a total inflow which is close to 90,000 crores as compared to 7,500 crores that we got in the previous month, but this is largely led by the debt schemes. However, if you have a look at the equity schemes, what you were mentioning, that is in fact correct. It is an outflow number which has come in for the first time since in last 4 years itself. So that number stands at about 2,500 odd crores in terms of outflow. And if you add the hybrid schemes also to that, which is close to 7,500, in total, the equity schemes would have obviously seen about 10,000 crores of outflow from the equity mutual fund scheme. So that is the disappointment that has come in from the data that has been released by AMFI. Now, as far as the total assets are concerned, there has been significant growth, 5% on an overall basis. 27.3 lakh crores is what the industry manages right now. And the equity AUM has also jumped about 6% on a month-on-month basis to about 7.3 lakh crores. However, this is still less than what the Nifty actually returned for the month of July itself, because remember that the Nifty surged about 7.5%. So 6% growth in total equity AUM. But coming back to the inflow picture, if I have a look at the equity categories, the various categories like the multi-cap, large-cap categories, so on and so forth, all of these categories have seen an outflow except for two, which is the focused funds and the ELSS scheme. So, rest all have seen an outflow where the multi-cap outflow has exceeded 1,000 crores, and you have the mid-cap category also, which has seen an outflow of more than 500 crores. And the large and mid-cap schemes have seen almost 5,000 crores go out from their kitty as well. So like I said, absolutely disappointing. And remember that the last time we saw an inflow of about 241 crores which was for the month of July. When that data was released, the Nifty had a rude shock on that day itself, declined more than 100-150 points from the top. So this time around, in fact, we have got an outflow number. While the SIP number is still to be declared by AMFI, we'll keep a close watch on that as well. But like I said, absolutely disappointing from the data that we have got.
All right. Net equity outflow 2,480 crore rupees. Remember that in the previous month as well, the inflow number was extremely small at just about, I think, a little over 200 crore rupees. The total AUM, though, has come in at 27.3 lakh, equity AUM at 7.3 lakh crore. This is the information that we have for now. It'll be interesting to see what sort of category movement that we are witnessing, or rather category flows that we are witnessing. If I remember correctly, last time we did see a resilience of sorts in inflows in particularly small cap and mid cap funds. So that will be something interesting to watch out for as well. ELSS as well did see an uptake, but that's perhaps because of seasonality, because of the fact that we had till 30th June and then subsequently 31st of July to make your tax saving investment. So perhaps that's also the reason why we did see this increased inflow in ELSS schemes. Okay, moving on, pharma stocks is something that we cannot keep our eyes off because of the rapid rally, and now we have Q1 results as well. Cipla is in focus, Divi's Labs is in focus, even a small cap pharma name like a Shilpa Medicare is seeing a massive rally. Let's go across to my colleague Pankaj Podar. Pankaj, first to Cipla, what are the numbers like? What are brokerages saying?
So, Cipla has given a great set of numbers. I mean, the EBITDA that they have delivered, the sort of India business growth that they have delivered, the US market, the way it is done. I mean, it's a fantastic set of numbers. And that led to the operating leverage, which led to an EBITDA of about 1,000 odd crores. 24% is, of course, the EBITDA number. And just look at the stock price. I mean, you can call it frenzy, you can call it anything, but, this is what it is. It's at 800 rupees. It's done pretty well from the lows and continues to be the case. Brokerages have upgraded their target price. The target price are now in the range of 800 to 850. Most of the people have a positive rating on Cipla, and that continues to be the case. Also, let's just point out Divi's. I mean, 15% higher. It's a 70. It used to be a 75,000 market cap crore company till Friday. It's a 15% addition to that. Great set of numbers once again. Margins much higher than anticipated. 40% gross margin is what the company has delivered, and that's led to another round of re-rating. Mind you, Divi's is not a stock which is depressed. Divi's is not a stock which has led to any sort of problems. So pharma as a pack continues to do well. Some people thought that these numbers are factored in, but somehow you just get a sense that people are just getting surprised as far as these moves are concerned.
Right, thanks Pankaj for that. Definitely a solid up move being witnessed on a lot of pharma counters. You have Cipla, Aurobindo, DRL, Divi's Labs, Laurus Labs, all on an all-time high, and Ajanta Pharma, Sun Pharma, Shilpa Medicare. These are some stocks that have reached the 52-week high as well in trade today. But let's shift gears and focus on some key earnings that will be delivered this in today's session. Vinny standing by with the poll for Titan. Vinny, tell us what to expect.
Titan is set to post its Q1 FY21 numbers, and it's going to be a tough quarter for the company. We're expecting a revenue decline of around 63%, and the revenue will stand at 1,873 crores. While in terms of the profits, also bottom line, we are expecting a loss actually this time around of around 127 crores versus a profit of around 370 crores. So a really tough quarter for the company. In terms of the EBITDA also, we are expecting an EBITDA loss of 70 crores versus an EBITDA of 564 crores. So we are seeing a really tough quarter for the company, especially in April. The sales of the company were virtually zero. So that is something that, even is accounting for it. Plus consumers are still not coming back. This is a discretionary spend. Most of the items of the companies are discretionary spend. So it's not something that consumers are willing to go and spend on as of now. So it's been a tough quarter for the company. Also in the Q1 update which the company gives, they have also given that the revenue, jewelry revenue is expected to decline by 75%, while watches division revenue is expected to be muted also and will decline by around 90%. While in terms of the eyewear segment, also we are expecting a decline of at 85%, and this is obviously mainly due to the lockdown disruptions as well. And overall jewelry business also is impacted due to the wedding season being postponed. They are deferring the wedding season. Launches were also not there during this quarter, so that is something that has impacted the company. They also said that they'll be postponing the launches to Q2, the quarter 2 of this year. Plus, high gold prices is also something that has impacted the company. So overall, we'll keep an eye out for the numbers, especially in terms of the commentary also is something we'll watch out for. What are they seeing in terms of demand recovery in July, August? What are the, what are their outlook on the gold prices, plus any guidance if they're giving for FY21?
Okay, Vinny, thanks a lot for that. Well, we also have Shree Cement's Q1 numbers that are expected today. Of course, there is going to be, a decline on the top line on account of the lockdown, which has drastically cut down volumes. Vivek Iyer joins us for a heads up of what to expect. Vivek?
You're talking about the cement universe, and remember, the cement universe this time around has come up with a set of numbers. Even the volume decline has been extremely high, and in fact, volume decline has been in the high 20s. When you're talking about most of the companies, especially based in the North India, you're talking about very strong realizations, helping them and protecting their margins. You're talking about Shree Cement. When you're talking about the numbers on a year-on-year basis, revenues are seen down almost 23%. EBITDA is seen down almost 17%. And when you're talking about the profitability, it's seen down almost 31% on a year-on-year basis. The most important number, that is the volume offtake, and Citi has an estimate that they expect volumes to decline almost 20% on a year-on-year basis. So despite the fact that you could see a certain amount of prices holding up, realization trends could remain muted on the back of the fact that offtake is really quite low. Remember, this particular quarter is expected to be a washout quarter for most of the companies, and Shree Cement will not be any different, given the fact that you saw absolutely no construction activity, both in terms of infra as well as real estate during the initial days of the lockdown. Key points to watch out for: commentary in terms of the volume offtake, the actual volume offtake, how is the company seeing resumption of infra as well as construction activity post the lifting of the lockdown, and any kind of commentary in terms of plant resumption as well as any project expansion activities that the company that earlier had said, but it will be important to track whether they've put any of the capex plans on hold. Very important result to track. Remember, the company trades at quite high valuation even relative to its own peers.
Vivek, for that. Moving on, the Supreme Court today will be analysing the financial condition of telecom companies currently undergoing insolvency proceedings and determine if they're actually in dire straits or they entered insolvency to avoid paying AGR dues of over 40,000 crores. Companies under the top court scanner are the likes of Reliance Communications, Videocon, Aircel and Sistema Sham Teleservices. Abhimanyu joins us with more.
Today, if 4 telecom companies are faking insolvency to avoid paying AGR dues worth over 40,000 crores, the top court will analyze financial details of Reliance Communications, Videocon, Aircel and Sistema Sham Teleservices. On the 20th of July, the top court had asked the DoT to provide financial details of telecom companies under insolvency to examine the bona fides of these companies with large unpaid AGR dues. The court had observed that there is a need to ensure that IBC is not being misused by telecom companies to escape liabilities, while the court had also refused to allow any recalculation of AGR dues by telecom companies. The top court ruling is still awaited on how much time telecom companies will get to pay AGR dues.
All right. Okay. Well, on that note, thank you, by the way, Abhimanyu, for that. On that note, we will take a very short break right here on the show. Welcome back. You're watching Buy Now, Sell Now on ET Now. Maruti is confident of a resurgent demand for cars as the threat of the virus abates. One of the most respected voices of the automotive industry is clearly looking beyond the COVID crisis and wants new launches to proceed as per plan. Here's an excerpt on what will be driving demand in the future, demand trends in other geographies, and how are imports of components by OEMs being replaced by made-in-India alternatives.
I think at the moment the total vendor imports, excluding the semiconductor areas, is probably around 14 or 15%. And we expect that to come down to 11% in the next 3 years.
Given that government currently is increasing dependence of local manufacturing, are you looking at fast tracking any processes with your vendors where imports, which is at 14%, will come below 10%?
No, it all depends on the availability of the product in India. If somebody sets up manufacturing in India, which we are trying, we are ourselves pushing for local manufacture. But if somebody doesn't have the technology here or doesn't set up the manufacturing plant, how do you get it in India?
Now, I'm going to ask you a difficult and a direct question, Mr. Bhargav, which is that the auto industry pre-COVID, like you said, was also suffering. The COVID crisis, in a sense, has shaken things up. When do you think things will normalize to 2018 levels? Is there a possibility of that happening in next 3-4 quarters, or we are still a very far distance away from 2018 levels?
See, I'm not an expert on the COVID, but what I do see and what I read about it from the rest of what's happening in the rest of the world, that the major requirement for getting back to normal working, and I mean normal working like it was pre-COVID, is for there to be effective vaccines available and a widespread vaccination program. Once that happens, then I think life will get back to what it used to be pre-COVID. But till that happens, I think there are a lot of people who will have to take all the required precautions for safety. You know, look at our Indian situation. The number of cases has not even started declining yet.
Mr. Bhargav, last time when we spoke, you alluded to the trends which are coming from China, where the COVID virus has settled, and you said that you were pleasantly surprised with the demand of cars coming back in China. So what's happened there in terms of a consumer trend, do you think could also happen in India?
It could happen if the COVID is completely controlled like they have in various parts. At least one doesn't know exactly what has happened in China, by the way. But assuming that what we hear that in many places it has virtually disappeared, if that happens even without the vaccine, then wonderful. I think we'll get back to normalcy very fast.
We also caught up with Dr. Pawan Goenka of M&M. He spoke to us and said that M&M anticipates rural rally to sustain over the long haul. He also talks about increased focus on EVs. Here's an excerpt from that conversation.
I think the last 2 months, since the time that you had Anish on your show about a month and a half ago or 2 months ago, a lot of things have changed, and mostly for the better. Basically for the rural economy and the agri sector, and that obviously is driving our performance in terms of share price, profits, and everything else that you would like to count.
Markets are excited about your capital allocation policy, Mr. Goenka. You know, I can get into demand and the rural impetus, but the need of the hour, I guess, for your shareholders and our viewers is that to understand your capital allocation policy. With each quarter, we're getting more and more sense that Mahindra & Mahindra now wants to focus on businesses which give which have double-digit ratios, and you will not, in a sense, go ahead with loss-making ventures. Let's talk about it slightly extensively.
Sure. I think what we had said last time, that remains, we remain consistent with that. That we are going to be looking at our businesses outside our core business a lot more prudently and look to get financial performance from these businesses in the short and medium term, unless they're strategically very important, where obviously we'll give a longer rope in such cases. And we have already made some very important announcements, starting with SsangYong in April, then Gen Z in June, and 2 days ago, we announced that we are not participating in the U.S. Postal Service bid that we are working on for the last 2 to 3 years. And these are all clear indications that we are serious about what we said on capital allocation. And right now, all the businesses are going through an analysis to see which businesses belong in a portfolio and which businesses we should exit either by virtue of selling them off or slowly tapering them off. That decision is happening real time, and as we come to conclusion on any specific business, positive or negative, we will take action on it and move forward.
Let's talk about
the entire confusion with respect to COVID, amidst you wondering how should you now drive your investment portfolio amidst all of this uncertainty, how to allocate funds in different assets, we caught up with Mr. D.P. Singh, the Chief Business Officer of SBI Mutual Fund, to understand the same. Here's a slice of that conversation.
Anybody who is having up to 3 to 6 months kind of period, so they will put money either in savings bank deposit or they will put in a short-term deposit of a bank. And today, in both the categories, if I talk about if I take a reference rate of State Bank of India on savings bank account, it is 2.7%. And the short-term FD is giving you 4.5% return. But compared to that, if you keep your money in money market fund, in any money market funds are likely to give you around the same policy rate plus 50 to 100 basis point return. So today, repo rate plus 100 basis points come to 4.5% kind of returns will come in that particular category. And for the short term, and any period for 6 months to 2 years, 3 years, the short term funds are the category where you need to put in money. You can put money there. There you will have some capital gains also. Especially so when we say, when there is a unanimity in the views that it's going to be further interest rates going down scenario, vices toward the interest rate further going down. And any money which is for more than 2 to say 4 years, 5 years, in that category we have medium-term funds. We have got dynamic bond funds where the fund manager play with the duration, especially in the government securities only. And the moment their opinion and their view moves that yes, interest rates can go down, they can bring down the duration to 1 year. Otherwise, they will keep it 7, 8, 10 years. So that fund category as well as medium-term category are going to be best for anybody who is putting money for 2, 3 to 5 years. So these are the categories for debt funds. And any portion which is beyond 5 years, so definitely the major portion should go into the equity funds only. That we always say. That equities over a longer period will definitely give much better return than any other asset class.
With that, we're timed out on this edition of Buy Now, Sell Now. So it's a wrap. Thank you so much for watching.